13 on your side's Money Guy, sponsored by Mercantile Bank.
There are signs that inflation is improving. We learned yesterday that consumer prices rose 7.1% in November. That was down from 7.7% in October, and it's the fifth straight dip.
Today, the Federal Reserve will decide whether or not to continue raising interest rates, and if so, by how much. So what does this mean for mortgage rates? We've got the answer in today's 13 on Your Side Money Guide.
Emily, I spoke with Zachary T-Boss, a mortgage loan officer with Lake Michigan Credit Union. He said the consumer price index slowing is a sign that the Fed raising rates is working to curb inflation, which is a good thing in the long term. It's very likely that if the Fed increases interest rates today, we will see mortgage rates go up again in the short term, but come down in the long term. He says by the end of 2023, mortgage rates are expected to dip to 5.4%. When we checked yesterday, they were at 6.125% for a 30-year. While mortgage rates are currently higher than they were this spring, Zach is quick to point out that many homes were selling for far above asking. He says in April, homes were selling for, on average, $21,000 above list price. As of November, just last month, they were selling for $2,000 under asking.
Buyers are actually able to get into a house for a much cheaper standpoint. Obviously, they do have the higher rate, but it's never been more true right now, which we say in my industry is you marry the house, you date the rate. You can always refinance down to a lower rate when and if we see them go down, end of 2023.
Zach says once we see inflation on a consistent downward trend, mortgage rates will follow suit.